Hello, everybody. John Blank, Zacks Chief Equity Strategist and Economist, talking to you today on Monday, July the 5th, 2022. As usual, I'd like to do the disclosures before we jump into the talk today. So once again, here they are. The views of John Blank, PhD, are not necessarily the views of Zacks Investment Research. Past performance is no guarantee of future results. The rest of this is boilerplate that all of you have seen before. Please stop and read it to make sure you understand. But basically, this is my view, but it is my view with a PhD, so hopefully you'll find it of use. So let's get going here. Today, how to find a top company in industry. Still working on this style box idea, but we're still working with those 11 top picks from last time in large, mid, and small caps. But we're going to take a different angle at how to find a top company in industry. We're going to look into some strategies, some consulting strategies, some top-down strategies to find a top company and industry. It's both of these things that you need to find. I mean, one of the things we need to understand here is industries get hot and then top companies in hot industries get hot as a stock. That is a classic pattern for the last century. We'll go through some of the new consulting ideas around finding those types of companies and industries. And again, we're going to go through these 11 stocks, but we're going to look at them 8 different ways through the valuation and metrics that are classic. And it'll be a thing that where you can get these slides from us and study these individual stocks for yourself. So this is going to be a very active management situation for you. But at the end of the day, I'm going to go through these slides fairly quickly. So you're going to have to get them later from us at Zacks to study these things closely. So please understand that. Okay, so part 1, strategies to find a top company in industry. All right, we're going to go through basically 4 of them. The first 3 are going to be mainly about companies, and then the last 1 or 2 are going to be about industries. So first thing we'll do is go 5 phases of an organization's life cycle. This is a classic model just to think about how companies go from small, middle to large cap companies, and then what happens after that. So we'll have 5 phases. Notice there's 5 phases. We've got 3 market styles. So there's actually a couple extra phases on top of the market cap phases that we're talking about to look into. So keep in mind, I'm talking about 5 phases. Maturity stage scenarios is effectively the same thing, but we'll take a different groups look at the same idea to give you some different insights into how this process can be played out and how you can take advantage of it. Finally, I am a former Boston Consulting Group BCG consultant, so we will go through the BCG Growth Share Matrix. This is very old, been around for a couple decades, but it's worth reviewing. Finally, Harvard Business School professor Michael Porter has also written books. He had a company called Monitor for many years. I think it's still out there in some form, and it's got a 5 forces analysis for industry studies, finding a top industry. Here at Zacks, we do have industry rankings and heat maps on our Zacks.com website. And those are the way that we can, congeal an earnings type approach to this. This is a little more deeper into actual studying the entire industry. So these are great summary ways of getting into studying what you would like to own. What would you like to pick, and also finding the weaknesses. Okay, number 1, like I talked about, 5 phases of an organizational life cycle. Each stage lasts for a certain time before the market moves all companies in that industry onto the next stage. All right, so this is basically about a given organization now, not an industry. We'll get to those later as I talked about. So number 1, a birth event, starting a company. The last 25 years, there have been 2 big tech bubbles, a lot of birthing events going on. We all know about starting a company is where a lot of the growth is, a lot of the employment is, and a lot of the setups for the rewards and equity get made. Second, a growth stage where they're actually building the company. Here, the organization either grows or fails. And obviously you can do both. So there's still a lot of risk at a growth stage company. If you're growing, great, that's fine. The market will reward you. But if you're failing, you will actually suffer quite dramatic losses as a stock. So growth stage companies, I like to think of them always as beneficial, but if they fail, they're not. And that is basically why there's a lot of risk at small caps. A maturity stage. The dangers here are stagnation, bureaucracy, and failure to innovate. All right, so maturity stage is kind of in the middle to small to large cap area. Stagnation, bureaucracy, and failure to innovate are often things that seem to find their way into particularly the largest companies, the large cap companies. But you can get down in the 4 or 5 billion market cap companies and find plenty of this going on. Finally, 4 and 5. Okay, these are stages that we would like to not believe in, but creative destruction is out there. A decline stage, growth and innovation slows, and the organization becomes a self-perpetuating bureaucracy that creates diminishing returns. You know, this is an organization that no analyst likes to find, no company likes to talk about. But if you're seeing EPS growth declining year on year, and it keeps on having stories about too many layers of management, this is the kind of company you want to stay away from in the large cap space. However, you can get new management, and new management can sometimes turn it around. So that's number 5, renewal. This can take many different forms. To get an organization turned around in the right direction, that could be a merger, acquisition, or sale, or just change of management. So again, decline and renewal and maturity are all kinds of stories of companies and the battles they go through perpetually, really, about trying to keep themselves together. All right, let's go to the maturity stage scenarios. This is a product life cycle. It's a series of steps for which every product goes through. So companies and products, kind of similar. When you're a single product company, you are the same. The ones we talked about and this are the same, but when companies have many products, a lot of these are going on within the company in a diversified mix. So this is about the products. And we go through pioneers, just like we had before with companies, growth, early and late stage, maturity, like we already talked about, and then decline. So once again, it's pioneers to early growth, leaders and followers. However, there you get an example of something different. Just because you put a new product out there, you're going to get competition. And you're either going to stay in advance and lead it and the growth, and you're going to keep that product moving, or you're going to fall behind. So pioneers can turn into followers pretty quickly if they don't watch out. You want to stay in the early growth leaders area. That is the key. So then you get to late growth. And then finally, after that, maturity, which then you get a set of 4 scenarios, not really maturity because you're really figuring out more and more about the product. You get to a concentrated market leadership position where you own a lot of the market. Think of this as a Google, and you're, but you're also very concentrated. You own so much of the market. There's really not much more for you to get. And then concentrated market followers. You might have found yourself to be in a very concentrated market with not a lot to show for yourself. And then there's fragmented markets, which are, from a competitive perspective, very desirable, but from a profit perspective, very undesirable. Finally, scenario 9, decline. So again, this is stuff for keeping in mind that anything can happen to companies. A lot of the message here is study the products in these companies that we're putting up for you today. Get involved in thinking about what they do with products. Okay, the Boston Consulting Group Growth Share Matrix. The Growth Share Matrix, put simply, is a portfolio management framework that helps companies decide how to prioritize their different businesses. So again, we've gone through setting up businesses, setting up products, but now we're going to choose the actual products portfolios. So the example here is Apple. And I've got a study here for you. Market share runs on the bottom from high to low, and market growth runs on the here from low to high. So what we're looking for here is something that has high market share and high growth. That's the star. That is literally called the star, and that would be the iPhone. Now, let's say we got low market growth and high market share. That would be iTunes and Apple MyBook. That would be right in here somewhere. They would be around in this point. Then we get down here, low market growth and low market share. This is really not a good place. This is the dog. This is the iPod. So over in this area, these are the guys we're going to want the company to get out of. These are the ones you'd love to have stick around because they've got market growth and market share. That's your iPhone, of course. Then you've got these ones where you don't have a lot of market growth, but you already had concentrated market share. Those are your cash cows or iTunes. That's up in here. So this is obviously you've got strong market shares for these companies. Now down here, One last group, high market growth and low market share. That's over here. Okay, that's the question marks. Those are ones that you're growing your business, but you don't own very much of the market. That's Apple TV. So Apple iPod, iPhone here, Apple TV here. The iPod is down in the low, and then over here you've got your iTunes and MacBook. So point being that you really want to get out of your iPod dogs, and you love to keep your stars and your cash cows and your question marks around. That's basically the idea here. You don't want low market growth and low market share companies. I mean, again, at Zacks, we do a lot of work in market growth and market share, but you want to think about the entire product composition of these companies and whether they're managing in this manner, the mix and changing products in and out in this manner. All right, now let's get to the industry level. Harvard Business School professor Michael Porter, a very well-known guy. And this is a model that identifies and analyzes 5 competitive forces that shape every industry and help determine the industry's weaknesses and strengths. So I'm going to put 5 together. Obviously, I've got 2 different charts, so you can review them in pretty good detail. I'll go through 3 on this chart, and then I'll go through 2 more on the next one. So first, threat of new entrants. Always can get new entrants into any industry. So is there barriers to industry, economy to scale, brand loyalty, capital requirements, cumulative experience. How long has the industry been around? Government policies. Is there going to be policies that affect this industry? Access to distribution channels and switching costs of products. So this is the key thing. You want to think about how easy is it to put in new entrants into the industry. Number 2, bargaining power of suppliers. There are industries that get supply from somewhere. And you want to think about the number and size of those suppliers, the uniqueness of those suppliers, and the focal company ability to substitute. So can this company that you're looking at, can it substitute its suppliers? Bargaining power of buyers downstream. How many customers do these people have? What's the size of each order? Differences between competitors, price sensitivity, ability to substitute, buyers' information availability, and switching costs. So again, this is all new entrants, suppliers, and buyers. Now let's go to the last 2. All right, so what you want to think about is each of these factors influence the profit potential within the industry, Moreover, the companies that are considering whether to enter a particular industry, these 5 forces analysis can help determine whether profit opportunity exists. So people who do want to enter these industries are also studying these profitability things. The point is here, when we get later to the Zax Rank, these are the factors, the hidden factors, the talked about factors, the articulated factors for trying to figure out the profits that will show up and create the Zax Rank. So then competitive rivalry, number of competitors, diversity, industry concentration, industry growth, quality differences, customer loyalty, cost of leaving market, brand loyalty, barriers to access, switching costs, and over here, threat of product substitutes. Again, the number of substitutes products available, buyers, switching costs, perceived level of product differentiation. All this is important stuff. To put this language in your head and go through it. So take the time and study these different ideas, because these are the kinds of concepts that you can use in meetings to discuss whether or not a business is good. All right, so the last section that I'm going to go through here in this first part is the actual scenario the marketplace, the financial marketplace, is leaving us to pick stocks. So I'm leaving the company and industry, and I'm entering the financial markets. So first of all, we've got Tobin's Q and Schiller's PE. So we want to study whether or not what the status of this market is. Now, the Q ratio, known as the Tobin's Q, is the market value of a company divided by its assets. So if the market value of a company is way over 1, that's probably a good example of overvalued companies. And certainly the more higher the Q, the less valuable it is to buy the company in a stock market perspective. So let's look at the Q. The Q is at 1.6. It's actually much lower than it used to be. When it, for many years it had been over 1.8. Now we're down to 1.6. So let's back to the 2015 level. So we're starting to see from Tobin's Q right here, as you can see, that we're in, not really attractive spots. These are down, here at the 1 and 1.2, but we're at 1.6. So what does this tell us? It can go a lot lower, folks. We can get down here, but we're right there, and that is, 5 or 6 years better than most things. Now we get also get the Schiller's PE ratio. This is much more, incorporates a lot longer 10-year cycles of earnings looking back. You can see that's a 32, which is, again, looking over this, fairly high. This is a fairly high level of valuation, and you don't see that but before the 2000 bubble. So what this is telling us is market's, definitely cheaper, and it's been a number of years, but it's actually not cheap. And that needs to be kept in mind. So down here, we're going to get a little more into the stocks and bonds relationships. So this is the equity risk premium, ERP, the Bank of America Merrill Lynch AAA effective yield, which is the orange line, and LIBOR 3 months. So this is basically your Fed funds rate effectively. And you can see we are cranking it up, but all we're getting back to is the 2019 levels, or what we saw in 2003. Now the AAA bond rate is at 3.6. Again, this is just getting back to where standard points of view were. However, you can see the equity risk premium at 4.5 is sort of back in this period. Not as great as it's been for many years, certainly from 09 to 12. This was the real sweet spot for the equity risk premium. We don't see that now. We're seeing that down here. So again, this is telling us, by and large, we're in one of these middling areas right now, not as great as we'd like to think. Then down here, we've got the corporate income tax and the inventory valuation adjustment. This capacity utilization total industry UT is not worth much. The inventory valuation adjustment and the tax rates are probably interesting. Tax rates have been actually fairly high relative to history, but no higher than they've been before. Certainly from 13 to 15, they're about the same. But this is what's interesting, the valuation adjustments for inventories. A lot of low inventories out there because of COVID. This is driving a lot of the inflation. There's just simply not a lot of inventory products out there. So this is very specific to this period of time. As you can see, we do not see anything with inventories. Now we really do see big declines in inventories. So again, let's go through Tobin's Q and Schiller PE. Yeah, Schiller's PE is kind of most pained from a valuation perspective. The Tobin's Q is not bad. Still can go down though from here. Here, equity risk premium and AAA bonds and LIBOR are, not great. And then down here, you've got this incredible story of inventory valuation adjustments. By the way, that's kind of bullish companies because you still got inventories to build. You still have products and growth to add back to get those inventories to where you'd like to be. Okay, so now we're going into these 11 stocks, looked at 8 different ways. I'm not sure how quickly I can get through all this. Obviously, this is going to be better off when we get into this detail for you to actually get these slides, because now we're getting into 11 stocks. But keep in mind, once again, this is a style box thing. We're looking at growth and value, large, middle, and small caps. And the name blend will be any index that considers itself a little bit of value and a little bit of growth. Value stocks are typically low PE ratio, low price enterprise scores, and growth stocks have higher ones because people are buying and paying more for stocks because they think the growth, the earnings and revenue growth are there. So again, these are the names. Again, we've got about 10 or 11 in each of these. We put these up last time. I put them up again this time so you can understand and reference back to these names and go on to Zacks.com. Here's your large caps: Applied Materials, Target, Texas Instruments, Union Pacific, etc. These names you probably know well. The mid caps, actually a fair number of those you will know, and the small caps you probably do not know. So making sure you understand these different names as we go through from here. Okay, so this is an interesting slide. The yellow is the S&P 500, the S&P 400, and the S&P 600, the Russell 1000, the Russell Midcap, and the Russell 2000. So here you have a reference for their given index for the company. This is what's useful here. You can do this index for these sets of companies, these two indexes for these sets of companies, and this set of indexes for these sets of companies. And the point I want to point out here is you want to look at periods of recession or expansion and see how that company has done. So if you think we're going into a recession here, and that is, you're going to look for companies that do well here. You think this is a recession period, these are the stock picking areas to look at. You think we're going into expansion, these are the stock picking areas to look at. So this is the key idea here, is that if the market's going into expansion or recession from here, you can pick stocks based on that here. So again, if we go into recession, these are the columns you're going to want to look at right here. And if we're going into expansion, these are. And as you can see, very different stories in one or the other. And that is a key style rotation and stock picking idea. So this is a great slide for you to understand if we do a recession or expansion in the next year or two. Okay, valuation keystone analysis. Obviously, the classic thing here is the price to forward earnings ratio. This is done in 7 increments of time. So here's your first 7 increments to 2021 going back. Here's your next 7 instruments. Here's your final next 7, and then 7 all the way back to 2000. So here's from 2000 to 2007, 7 to 14, 14 to 21, and so on. So this is your month end. I would like to just use the average here, 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 and here. And then look to try to understand how much it moves, the standard deviation, and then the min and max of those stocks valuation. So you want to say, for example, AMAT, we've got an average PE of 15. It's at 15.5 now. It's basically its average. You can get half of that or a little bit more of that. But basically what you want to point out is right now, over the last 7 years, AMAT's trading at its average. This is basically true along all these things. You're going to see, for the most part, some of these are a little better than most, but on average, all we've done is gone back to the average PE of the last 7 years here. You know, again, you can look through earlier periods and other times. This gives great analysis to try to understand whether you should be picking a company here for that's in a good, strong place for you relative to the cycle and relative to its competitors and relative to the other market caps. And again, that gets back to those early first slides, trying to use that information that we showed you to find maturity stage companies that have the growth and that competitors are not going to knock it down. Okay, so then there's a price to free cash flow. This is a related idea to price to earnings. Now we're going to price to free cash flow. Very similar ideas. I put these 2 slides together for you in order so you can toggle back and forth like I just did, one to the other, and find your way through the same companies. And this is the very, very same arrangement with averages, mins, max, standard deviations, and the month end to the basically first of June, end of May. This is where we're looking for those marks. Okay, then we get the price to enterprise value. This is get into a much different idea because we're looking into the overall value of the company versus just the earnings, the flow value. So these are, you know, the actual size of the company and the price that people are paying for that company. Again, we've got all kinds of information here for you to look at, and it's very valuable for you to do so. Okay, price to sales. Sometimes companies don't have a lot of profits, and this is a better way to measure them in terms of if they're growing their businesses. So again, this is going to be one where you're going to have to keep the sectors of the style boxes in different orders because price to sales will definitely play out differently. As you can see here, sometimes price to sales for big companies is very, very high because they're so big. And down here, they're not so big because they're don't have a lot of sales. So this is the basic idea that you're, again, to our original point, you're going to get your sales up and grow these businesses into larger and larger sizes. That is this idea, and you can look at who's doing that better within these groups, right? For example, we keep AMAT in the growth style. We keep MO in the value style. Some get in both, some don't. So here you go into all the different style box ideas and where you can put your valuations for these companies. That's the idea of value growth. Okay, price to book value, another idea that's very similar to this one and somewhat similar to that one. These are all basically ideas. Again, you can toggle around, but we want to basically use this particularly for things like banks and things like that. Asset management type companies, REITs, things like this are often well regarded in terms of price to book values. So again, it's not a one-off thing. You want to use all these charts at different points in time for your analysis. Okay, so reinvestment rate, this is the amount of cash flowing. Again, these are all the companies, large cap at top, mid cap here, and the small caps at the bottom. Kind of a noisy chart, but I want to point out something interesting here. Reinvestment rates, as you can see, particularly the small cap values in 2008 were much higher in general than they are now. So this is something that happened. For whatever reason, after 2008, the small cap companies were not able to reinvest and grow as strong as the larger cap companies. You can see that up here. In particular, you can see them kind of growing and growing and growing. You can see through the pandemic, the large cap companies did a lot of cash flowing and reinvesting. They did extremely profitable large companies. Down here, not so much. This is something that concerns everybody because large companies are winning in the post-COVID environment and the COVID environment. Okay, so dividend yield percent. If you're looking for income stock, this is a great chart. Again, you can see over here all the different names that we looked at compared over time, but very fascinating, interesting study to find income stocks and how the income has held up over time. Remember, it is about how it holds up over time. And again, lots of variation and volatility down here with the small cap. Sometimes you'll find, obviously some pay very little and some actually pay a lot because we have some REITs in there. Small REITs actually pay quite well. So don't get carried away and think that you can't find a small cap stock that offers a dividend yield. Actually, you can, and some of them are really good because we have some REITs in here. So pay attention to this for you out there that are looking for income. Okay, now I'm going to go into our final section here, which is the Zacks Earnings Rank Analysis. So we're just going to get into, actual what our company does. So number one, the EPS surprises. I don't have any timelines here. What I want to point out here is, again, you've got your ticker names here on these rows. And then you've got just the amount of jumpiness. What you'd like to see is no downside surprises during periods. If you see a lot of these negative surprises, that's a stock that's not very stable in a poor environment. So just look through here and look for the company you're interested in and see if it has a lot of negative surprises. That would be of concern to us at Zacks. Large caps are at the top, mid caps are in the middle, small caps at the bottom. Price to earnings growth, PEG ratios. This is something, growth at a reasonable price. This is very critical. We have all the current PEG ratios here and here. You can also look over time and relative to competitors. Again, fascinating chart. We can get into this in great detail and the diversion, the dispersion of different growth. This is a key chart for picking a stock. I would actually tell you this is probably the most key chart for me personally. I would spend a lot of time here on the PEG ratio charts. Return on invested capital. This gets fascinating too. Again, a lot of different stories here based on business models, but this is another chart you can use to find companies that you really like and work well for you. Then free cash flow, return on investment. This is another fascinating chart. Again, you'd like to see a lot of free cash flow over return on investment. This is the companies that are really doing well. Again, it's a study that's going to correlate with a lot of other things like we've seen with return on invested capital, earnings, PEG growth, and of course the surprises. All of these are coming together and they make the backbone of what our last and final slide is, which is the Zax Rank. Folks, this is our company's main product. It summarizes all those information that I provided to you. Very kind of small print chart. This is something you really need to get a hold of from us. But this is the stability of our rankings for the given companies that I've shown you today. This is key if you're looking to hold a company in portfolio for a long time. You'd like to see the ranks hold up over time. And that's the point here. I really think this is a nice way to end it. And I do want to thank you all for attending this session of the Zacks Professional Services service for you in picking stocks in the style box, large, mid, and small. I hope you enjoyed it. Obviously, most of what you need here is the slides. Here is the information I have for you on how to get these slides from us. Because at the end of the day, this is a portfolio management tool. Zacks Professional Services puts together a great deal of data that's out there for you to use, but you need to find our way to us so that you can get a hold of it. Number 866-794-6065. Email strategycall@zackspro.com. Website www.zackspro.com. You can find us on Twitter at @ZATools, and you can find us on LinkedIn in Zacks Professional Services. So this is the end of my talk today. And once again, I'll leave this up for all of you. It's 866-794-6065 or strategycall@zackspro.com. That will get you to these slides and this talk, and you can get into the details yourself. Thank you for your time today, and that's it for me.